Just while everyone's getting seated, my name's Alex Dauria. I'm a senior portfolio advisor with Aksia. Aksia is an alternatives-focused investment consultant, so helping folks with private equity, private credit, real assets, real estate, infrastructure in their portfolios, as well as hedge funds. I'm joined here by three great folks. I've got Daniel Miller, who is the Deputy Executive Director for the New York City Board of Ed, Steve Swanson, who is the Executive Director for Chicago Park Employees, and Derrick Dagnan, who's the CIO of Fort Worth Employees. So really quick, if we could just go down the line and introduce yourselves, where you sit in your organization and your background.
Sure. Hello, everyone. Daniel Miller from New York City Board of Ed Retirement System. We're a $9 billion pension plan of New York City, non-pedagogue DOE employees. I've been there for 18 years, right out of the undergrad and worked my way up. We invest in pretty much every asset class but hedge funds, and we're 122% funded.
All right, Steve Swanson, Chicago Park District Pension Fund. I'm the Executive Director. First of all, thank you for inviting me here. It's great to be here in Texas. Talk about this, though I suspect I was invited because compared to everywhere else, the way we fund things in Chicago, you're going to feel better about yourselves. Because I can tell you we're not 122% funded. We're 28% funded, and we've got a law was passed last summer to give us actuarial funding, which put us on a 35-year schedule, which I think would get us in trouble with the people who just presented. So see, everybody feels better already. So that's what we're here for in Chicago. My background is I spent 21 years as a municipal employee. My last stop was the Director of Finance for the Chicago Fire Department. Then I moved over to the pension fund side, became the Executive Director of Chicago Firefighters Pension Fund, and then on to the Chicago Park District Pension Fund. Like I said, we've got about $400 million in assets, but we're severely underfunded, but we are starting to receive larger employer contributions. But it still leaves us with a negative cash flow, meaning our pension benefits and expenses that go out every month are less than the contributions that come in the course of a year. So that is still a real problem for us, and that's really our primary focus right now, is dealing with that, particularly with the current market situation. Where are we going to pull those assets from when we need to make those benefit payments?
Derrick?
All right, and I'm Derrick Dagnan. I'm the Chief Investment Officer for the Fort Worth Employees Retirement Fund. We're police, fire, and city employees, a little bit under $3 billion in size. We run an endowment-light model. My background, I was a sell-side equity analyst working for banks for several years, and I worked for the Tennessee Treasury Department for defined benefit, defined contribution, all that, managing money there. And joined about a year and a half ago. And this plan is around 60% funded. And so See,
you feel better, don't you?
Yeah. Yeah, I really do. So, yeah, that's about all I got. Yeah. Really happy to be here.
Perfect, starting off with a little controversy, I love it. So you've given kind of a high level, but let's talk a little bit more about portfolios, broadly speaking across assets, how are you allocated? And then looking forward for 2022, at a high level, what are your objectives? Yep, let's just start in the same order, unless someone has something super spicy to say, and you can jump in.
Well, he's from Chicago, so it's going to get real spicy with him, I'm sure. So we're about 50% equities, 28% fixed income, and the rest are alternatives. We're putting to work about $925 million this fiscal year for us. Really looking forward to changing our emerging manager program, how to do that better, take a little bit more risk and allow some first-time funds, given our funded ratio. We started our private credit program about a year ago. It's a 5% target. We're 1% there right now. Kind of focused on direct lending. In PE, we're looking at some growth equity, more lower middle market, and looking at core real estate for this year.
Great. We'll flip the order. Derrick.
Yeah, sure. So we've been making a lot of changes in our program, and we're around 45% in global stocks, about 16% in investment grade fixed income, and the rest in alternatives. But we've been making a lot of changes, and the reason for that is I was hired just really the first CIO that the plans had. And historically, it was mainly a consultant-run plan. And so just looking at what was in the ground and what needed to be done, we've embarked really on a journey. And we've made some progress, but we've got a long way to go. And so, it's not just managers, it's a lot of historical relationships and kind of reevaluating those relationships, and trying to understand kind of legacy assets and how do you work out some legacy assets. That's part of it, and then hopefully we're getting to the point where we really start looking forward, kind of discussing some of the things that other panelists are not panelists, but other presenters have discussed in the last 2 days.
It's no shortage of things to do.
Yeah, we have plenty to do.
Steve?
Yes, I mean, we are right now going through an asset allocation study. We just hired a new consultant in January, so we're on a lot of change in our plan. What we're looking at really is a bifurcated portfolio, having a liquidity side and then having a growth side. I'm a big proponent of that because really, while we technically are institutional investors, at the end of the day, a pension fund's job is to pay benefits. That's what we do. That's why we're there. And we want to make sure that that's handled, particularly, in volatilities, in volatile markets. Particularly any plan that has liquidity needs, you really have to pay attention to your cash flows because you can earn 7% over 20 years. And if you have strong returns at the beginning, you're going to end up with more assets than if you had weak returns in the beginning, even though it's the same, percentage you earned over that time, same rate of return, because you've got money going out. And depending when you have to, tap those assets to pay those benefits, you could be, locking in losses. So, we're trying to be really careful about that, and that's going to be, the primary focus, and then moving into, further into the asset allocation, filling it out from there.
It's a good segue into what I wanted to kind of hit on first. It's the big I word that we've been talking about quite a bit today, and that's inflation. So I guess, Derrick, starting with you, as you're looking at your portfolio, how are you dealing with potential inflation ahead? Are you making any major decisions? Are you, changing ideas that you had in 2021 as, the inflation word becomes more real in 2022?
No. So we've one of the things that's interesting about our program is we had some really large bets in our program for a really long time, like really from coming out of the financial crisis until I joined. There were 3 really big bets in the portfolio, and one of them was an overweight to inflation sensitive assets. So for about 10 years that was pretty painful, but it's been really good for the last year and a half. And so we have a lot of real asset exposure, real estate exposure, things like that have really helped us out.
How about you, Steve? I think you've taken a little bit of a different perspective given the portfolio construction.
Yeah. I mean, clearly we're going to be looking at some things in terms of that could be new to us in terms of tips. We're also looking at, with our liquidity, going more, short duration on fixed income, also looking at more high quality. We're really not trying to drive returns out of fixed income. Going forward, it's really just going to be a source of liquidity, and then hopefully we'll take any risk we can on more on the growth assets. But we do also have some things that have been built into our program over time in terms of infrastructure, real estate, things like that we know are there, that we expect to help us with inflation.
Daniel?
For us, in most plans, we really can't do many things tactically in a short given period of time, kind of like changing the Titanic. 7.9% inflation in the last year. We're long-term investors, take a long-term view. So for us, we think long-term equities will help us. If you look historically, the last 50 years, S&P 500 has done 10.9%. In that same time period, inflation has been 3.8%. So for us, it's just stay the course, long-term, we'll be fine. Even if we look at our returns year to year, from February to last February, we did 6.8, given simple inflation. We'll deal with that.
So, there's a chart earlier looking at what real returns on a go-forward basis look like, and a lot of traditional asset classes are looking, at or near zero on a real basis. So that's forcing a lot of folks to look into alternative assets as a way to drive returns in their portfolios. In the seats that you all sit in, you every day part of your charge is to take complex topics and dial it down and report up to your board. So I want to ask that you do that again here, and we stay at a high level. So no acronyms, as we have gotten in the weeds on various alternative asset classes today, but keep it high level. So do you have alternatives in your investment portfolio today, and what does that look like? I'll start with you, Steve.
All right, well, you don't ever have to worry about me saying anything complex, so it's not going to be a problem. Yes, we do have alternatives. I mean, we have private equity. We're actually looking into moving into private credit. Obviously, while those things can have volatility, usually, it plays out over time as long as you're a long-term investor. You can have that in growth, but you're not, riding that constant volatility that you see in the public markets. So we're looking at, alternatives for that, because obviously we want to drive returns, but also we have to really be careful on our liquidity, though. I mean, that's the concern with alternatives. How much can we lock up? Because at the end of the day, it's about making the benefit payments. We're going to go into growth and these alternatives because, that is to help us, eventually fund our liabilities. And we all know what liabilities are: future benefit payments owed. So again, it's just back to, how are we going to handle this, to make sure that those benefit payments, get made when they're supposed to, because that is the one thing that they absolute under the law that has to be done. They don't tell you what your assumed rate of return has to be, but they do tell you got to make benefit payments. So that's what we deal with, is the absolutes.
Derrick?
Yeah, so in alternatives, we have a pretty mature book. We have private equity around 12% of our portfolio. We have about 14-15% in real assets, and then about 10% or so is going to be hedge funds and other kind of alternative credit type investments. So, but a lot of it's been in place a long time, so it's a fairly mature portfolio that has interesting challenges, right? You have some. The one thing is, as in your seed, is these investments take a really long time. So sometimes I find myself focusing on not necessarily the return on capital, but the return of capital, because it's kind of important to get the money back at some point in the life cycle. And some managers don't think that's very important. It's like they're charging fees on it or something.
So in New York, we're a little unique. We have the basket clause in New York, where you're not allowed to have more than 25% of your allocation in alternatives. So we're in PE about 9%, real estate is 8%, infrastructure is 4%, and private credit, which is new, is at 1% right now.
So talked about returns, but are there other reasons to have them in your portfolio? Diversification, non-correlation. Anyone have thoughts there?
Yeah, I think you kind of hit the nail on the head. Going back to earlier topic on funding, a lot of public plans recently, in the last few years, last decade, have really upped the allocation to alternatives, started a program kind of to replace the lack of contributions from their employers. So if you're looking at it from that point of view, I think that's kind of the wrong way to go. You're not going to get your funding level up just on alternatives alone. You really need your employers and municipalities to make their payments. It's really for diversification, non-correlation. If you look at real assets, infrastructure, real estate, the factors that determine the returns there are really different than public markets. So it's kind of how you got to look at alternatives and also consider the fees.
Sure. Steve, Derrick, anything to add there?
Well, I think one thing that's important to think about is that in 1982 or whatever, we could all just sit around and buy treasuries and make our actuarial rate, assumed rate of return, right? So diversification is great and all that, but if we didn't get the return in the risk-free asset, we would have never even thought about buying high-yield bonds, right? Or some sort of private asset where everything's locked up. So
yeah, I mean, I see it from, the perspective in Chicago, where we're looking at private credit. I've seen some other pension funds do it as well. It seems like it's one of the popular alternative asset classes that's coming out now for public pension funds, because the funds have a little shorter lifespan than private equity, but also you're in a much better schedule in terms of getting your money back. With Derrick correctly mentioned, at the end of the day, if we can't make benefit payments with it, those returns don't mean anything to us. They're numbers on a piece of paper. At some point, the money has to come back into the plan and be used.
How are you advising your clients as a consultant on alternatives?
Yeah, I mean, we clearly believe in the portfolio benefits of the diversification, adding return streams, non-correlation, and in particular right now we talked about inflation, in real assets and real estate, having that inflation protection to a certain extent built into the portfolio is going to help the hitting return objectives overall. So broadly, very much advocating for continued investment in alternatives, and just looking for specific areas that are perhaps less traffic, so you can eke out return as more and more capital is crowded out more traditional spaces, traditional in the alternative sense. I think there's some folks in the room that are perhaps newer to alternatives and are looking into moving in. And I think, given your perspectives and where you sit, it'd be really interesting to hear any thoughts you have on, establishing good governance as you increase your allocation to alternative investments. Any best practices or ideas or things that have been challenging? Daniel, maybe I'll start with you.
The challenging part is we don't have a large staff. Most investment teams on the public side are pretty small. These are complex transactions. Sometimes you have to move very quickly on a decision, yes or no, do you want to do it or not, especially like on co-investments where you want to reduce your fees. That can turn around in a week or two. That's very difficult for the team internally to do the analysis and get back, work with your consultant. And then for us, the board has to approve each investment. And we have a meeting once a month. So getting that meeting scheduled, and because of the laws in New York, we can't have e-votes, it has to be an in-person meeting. So your governance is hugely important when you're talking about doing alternatives.
Derrick, I saw you raise your microphone. Looks like you have some
I
thoughts.
think you have to, as a trustee or a fund, you have to look at yourself and understand yourself and understand what, not necessarily what you're good at and bad at, but what you can be good at and what you maybe you can't be good at. And so what Daniel's mentioning, like the meetings and approving investments, that's a big deal. One thing that's really important to consider, to think about, most people in this room are not at a really large plan. And the large plans run the show, right? The large general partners and the large limited partners run the show on how this works. And those large limited partners have been able to hire staff. And so they have asked for increasing complexity from the general partner. And the general partners, there's two things. They've asked for transparency, which benefits all of us, but they've asked for increasing complexity, which doesn't benefit most investors, right? It benefits the large investors who can pay people who can do the analysis. And so the point about co-investment, that is complexity. And so it's already a complex investment, a complex process, and so now you have people, like on a smaller plan, you probably don't have qualified staff, and they're asked to do more and more things that are harder for even a qualified staff to do. And so that's something you really have to think about. And so in the case of like a smaller plan, to me, a smaller plan, it's okay to hire an outsourced CIO. It's okay to hire a fund of funds, and a lot of that heavy lifting, comes off your shoulders.
That's a good point you make about how more and more things are getting complex, and if you really want those fee breaks, you kind of have, that's where you're going. Now with tuition funds, that it was I think $1 billion 3 years ago, it's up to $9 billion this year, where a lot of the GPs will want to continue the private equity fund, and it's a great deal for LPs if you can do analysis in time, but most of us just can't do that.
Yeah, we're seeing across our client base right now, close to 70% of folks are unable to participate just due to these timelines in the continuation fund vehicles. We've heard, underwrites, data rooms open for as short as 10 business days. We're talking about governance here, and the challenges of meeting once a month. I don't think you're going to be able to underwrite a specific deal in 10 days. Just being able, aware of those challenges, and perhaps having a flexible governance structure if you do have the staff in-house to be able to do that underwrite and feel comfortable about taking that, more concentrated risk, to have the governance to actually be able to take action on that.
Yeah, and then the governance on trustee education for you guys as trustees, like you have other jobs, other time commitments, you have families. To educate you on these things, this is what we do every day. It's complex for us, so I can only imagine from your perspective how hard it is and the turnover there. So it's another issue with governance.
We talked about the largest LPs having massive staffs. Steve, given your situation right now, obviously staffing is a major concern with how you run your organization.
Oh, absolutely. The first thing we did, when it comes to alternatives, when we hired an investment consultant, that is an area we did focus on because we knew that was going to be important going forward. But obviously, we'd be more, a fund that's going to fund the funds and things like that because we're not going to be able to do those other things. And I think when you're building out your asset allocation, you have to look. Sometimes, people do these tiny allocations to very specific things. I think when you're a smaller fund, you really can't. You really have to keep it because otherwise you're really putting a lot of pressure on your trustees to understand all these smaller asset classes and things like that. You have to have it make more sense. And then I think even just in governance, when you're building out your investment policy, you need more than just, benchmarks in there. You need to describe what each asset class and the investment managers within there are supposed to do. Because, there might be time when you have a high quality bond manager that maybe is missing their benchmark, but they're doing exactly what you hired them to do. And, but the trustees need that in the policy that says, so the manager knows, and then the trustees have as fiduciaries, they know that, hey, I don't have to take this manager to task, they're missing their benchmark, but they're doing what we hired them to do. But your policy needs to say that. And so I think that's also with alternatives. You have to have good policies around this. So then, as trustees, you've got that to back up on why you made decisions, because it was, you're following your own policy.
So I think benchmarking is a really interesting topic to maybe spend some time on because it's a challenge in private markets. How are you all approaching that right now?
So I think it's a philosophical question and it's a practical question, and the philosophical question boils down to, are you focused on the return of an asset class, or you're focused on the opportunity cost? So we all start with a basic, you start with cash, right, and then you start adding things to it. So you have to think about the opportunity cost as you get more and more, creative with your benchmarks, right? Because then you build into policy, okay, well, we want 3% in emerging market debt, right? Well, maybe you don't need 3% in emerging market debt. Maybe it's a great investment, maybe it's not, but where's the money coming from? So that's kind of the philosophical question. Are you concerned about where the money's coming from? Or is it you're convinced that you need emerging market debt, and so then you build a benchmark off of that, right? And so the second part would be the practical is the benchmark investable or not? And so and when you get into alternatives, it gets really interesting because I don't think there's any. I'm not convinced that there is a great private equity benchmark. Let me say it that way. I think you can have the opportunity cost question, which is, well, where am I taking the money from? It's a replacement to public equity, so I need to make sure that I'm at least doing something better than public equity. That's one very rational approach. But then that's not investable. So then the practical question comes in: what's investable? And then maybe it's any number of vendors that are out there that can provide you with a private benchmark. And that's real estate to me is the easiest. You can go NPI, you can go Odyssey, and you can sleep at night. And Odyssey's pretty investable actually. And then when you get into hedge funds and private creditor and whatnot, that becomes a little more difficult. Somewhere in between real estate and private equity as far as the difficulty of being confident in your decision about selecting a benchmark.
Yeah, no, I completely agree because I believe, particularly with private equity, how I'm going to be able to invest in private equity at our fund versus someone at some endowment that doesn't have to do an RFP, that, has the money that they can just, re-up every time with the best managers. We can't do that. We're never going to get into those funds. It's never going to be an opportunity for us. And so to benchmark us, our performance of our fund, versus other private equity, it's just not realistic. We're not going to get the returns they are. I know that going in, but at the end of the day, we're just trying to improve upon our returns, so we can do our job, make benefit payments.
Is that a tough conversation to have? We want to use this index, but subtract perhaps, a certain percentage of spread.
Sure. We always have trustees that want, better returns. But we do have to be realistic about where we are and what we can accomplish. And also, for the trustees' sake, particularly in Illinois, there's no upside in taking risk. You're not going to get a bigger pension. No, all we're ever going to do is if we take more risk and drive bigger returns, eventually someday the employer might contribute less to the plan. That's it. If you want to take a risk as a fiduciary to do that, be my guest, but I recommend against it. I definitely have a more conservative approach that I believe, we should do what's right, try to keep employer contributions stable, but, don't take any unnecessary risk. Do what makes sense, what you understand and what you can explain someday. Because, particularly with underfunded plans like ours, we knew that, if something ever really went wrong, we're all going to get called on the carpet. It's just the way life is.
Something tells me the no-nonsense approach is going to resonate here in Texas.
Yeah.
Daniel, any thoughts on the benchmarking side?
I would agree with what both my fellow panelists here said. I think, especially in the alternatives, the benchmarking, if most people being honest, I think a lot of us are kind of grasping a little bit at straws there for the benchmark. Even with P&E for us, it's the S&P plus 3, is our benchmark for P&E. And getting that 3% liquidity premium, should that be 4? Should it be 2? It's really hard to decide that and how you look at things. So it's really interesting in how you look at it.
So I was at my prior place of employment. To give you an example of private equity benchmarking, we took the opportunity cost approach, right? We had private equity portfolio. We measured it versus S&P 500 plus 3%. And then we decided that wasn't very good, that wasn't investable, right? And so we switched to a vendor there's all kinds of vendors you can pick. So, but a private benchmark, right? And the timing on the switch was at December 31st of 2018, right? And so if you recall what happened in December of 2018 to the stock market, it went down an awful lot, right? So we banked massive outperformance in the third quarter. And then on the flip side, we banked massive underperformance on the rebound. But at the end of the day, it all worked out. We had this built-in performance cushion for years, and it may last decades, I don't know. But it's all phantom, right? It's not real. And that's kind of the problems you run into with benchmarking and having to change benchmarks. And it could completely go the other way, right? Where you have this phantom underperformance that's really not real, just because of what your benchmark is, or if you changed it and things like that. And I think it happens a lot to plans.
Something to add, Steve?
No, really when it comes, we're all concerned about returns, but at the end of the day, I spend more time working with our trustees in terms of understanding our cash flows and how, we're going to handle that and we're going to manage that process going forward, because it's, like you said, it's great to have the returns, but, it can be a bit of a phantom. Obviously, when it comes to the cash that you have, that's real. That's what we have to do at the end of the day.
So, Steve, you brought up the topic of RFPs earlier, which kind of leads me to what I wanted to talk to next, which was manager selection. So, you've decided to push into alternatives. You decided to build, pretty large portfolios. How do you think about your manager selection? Is it, firm handshake and a strong look in the eye and a slick marketing pitch?
No, I mean, again, we worked, when we were selecting a consultant, we really dug in terms of the research capabilities. We were really looking for strength there. Also, being a smaller plan, we've had a lot of plans, right now they're going through a consolidation in Illinois. All the smaller police and fire plans, their investment authority is being stripped away and it's being put into a larger plan. So also, we look for opportunities also in manager selection where we can differentiate ourselves from the larger plans. Because if we're not different, if we just do exactly what, all the bigger plans in Illinois do, why do we need to be separate? So what can we bring? So in terms of, plus, I mean, we think there's just opportunities for us too where, we're a smaller plan. I mean, if we're giving a manager $20 million, well, if you're giving that to, I don't know, I'll pick on BlackRock, I know they're here, but you give it to them, we're a rounding error. I mean, let's face it. Someone else, yeah, it's meaningful. That's an important relationship. And also when it comes to manager selection, obviously, we come from a state where, it's mandated in law in terms of, diversity. But a lot of those diverse managers are smaller managers that kind of fits with us, what we're doing. So we have a pretty good track record there in terms of, working with those, and we've actually had some pretty good results. So, we continue to look for those relationships because we just know as a smaller plan, we're gonna have to be a little different in our approach, because if we just, pull, the standard, just look at the biggest funds and go, all right, we're gonna do exactly what they do, there's really no reason for us to, to be, have investment authority. And I believe that investment authority best resides with the participants of the plan and, their representatives. And we're fortunate on our board that even the appointed members are all participants of our plan. We all are. And so I think it's important.
Daniel, how about yourself?
I think for us, strategy really matters. The manager, do you fit in a bucket that we have? And the timing, you could be a great manager, but right now we're not looking for buyout and PE. So it wouldn't go much forward. I think how your strategy and team has performed through market cycles, we look for that. Do you have a robust risk system, established front and back office? Is your team diverse? We look at that really heavily, especially now. I think that's important. Do you really understand your strategy? Has your strategy been consistent? Has it crept? Was your first fund at $200 million, now you're going to $1 billion? How's that change your strategy? So there's a lot of things that we really, really look for. And it takes time. We're a public plan, we're long-term investors. We really treat it as a relationship. We're not looking just to jump right in. We want to get to know you, who you are, and kind of what you stand for.
Derrick, how about you?
Yeah, I think, we focus on, I focus really a lot on process. I like to, maybe it's just a personal problem, but I like process that can be repeatable. I don't get too impressed with marketing pitches that talk about how important the team is, the all-star team. That's not something I really buy into that much. So I like process. On strategy, I'm mainly focused on a manager's strategy and trying to understand when it's going to underperform and when it's likely to outperform, and what kind of market conditions. What are the underlying conditions that create that? And then you can go back in history and you can say, well, we can try to replicate it, right? And that'll, that kind of tells you a lot, whether, is it just a story or is it real? And then I guess alignment is really important to me. So alignment between not just my investment and the general partner's investment, that there's money there that they're putting into the fund, but also alignment within their team. So are the economics of that firm distributed somewhat evenly throughout, right? Or is it just the couple people at the top making a lot of money? Those are the things I focus on.
One last topic as it relates here, just thinking about transparency. As we think about private markets, the first thing that comes to mind is not necessarily transparency. So how are you all kind of addressing that across your portfolios? Maybe I'll start with you, Steve.
Yeah, I mean, again, for us, when we're a smaller fund, so, that would really be, in terms of, having our consultant, dig down into things as well, in terms of what's going on, in the private funds. It's slightly off topic, in terms of transparency. in the pension fund world and the public information we have to provide just for the minute for the trustees, it is kind of amazing that, you've seen like hackers now starting to read pension fund minutes, pulling data on participants, sending in, false deposit slips. We've even had where another pension fund, they tried to send to the city treasurer to transfer money that they read about in minutes there. So I'm really interested in, just transparency around public pension funds going forward, because they're using our transparency against us now. They've figured that out. So it's going to be an interesting area going forward.
Yeah, I agree too. There's a lot of using transparency against us. It happens in Texas too. We have a very well-defined Public Information Act, and we follow that. And so after every board meeting, we get multiple inquiries, and we send out all the information that was provided. Not all, but everything that we're supposed to provide, we provide. And so transparency, and it's really it's comical when the people we send the information to turn around and try to sell us the product that is populated by the data that we send them, and so
for free, by the way. We pay for it, but we provide.
Oh yeah, we provide the data. Yeah, we populate their database for free, and then they try to sell it back to us. And what's even more comical is when they ask us to populate. If they don't ask for the information, they ask us if we can input it into their system for them. Then I'm trying to really figure out what they do for a living. So yeah, no, it's interesting. And on managers though, manager transparency is improved. It's improved versus 10 years ago. I think the managers get it, especially the large managers. The large managers deal with pension funds. They have to be more transparent than they used to be, and even in in some of the weird and more esoteric investments in the hedge fund world or in the venture capital world, those firms are growing, and they realize that it's more valuable to them to accept the pension fund money and earn the fee than it is to stay small and keep everything a secret. And so there's more and more information, that's more transparency between managers and what we see. I mean, how we can evaluate the manager.
Yeah, it's certainly something we've spent a ton of time on for our clients and invested a lot in the technology to support that analytical work, so you can get that top-down perspective, getting, for instance, in the private credit space, loan-by-loan level data, so you can aggregate that, because it's, really tough if you don't have that information. All right, really quick before I open it up for Q&A, because I want to leave a few minutes for that. So looking ahead right now, or reflecting on the conversations today, what do you think are the risks that we aren't talking about right now that concern you? Tough question.
I would say how much dry powder there's out there in the alternative space. A lot of managers have gone up to re-up so fast, and I think deals have been bidded up so high, the multiples are just kind of crazy right now. That really, really concerns me. Gives me kind of bubble feelings.
I would say maybe we all need to relax a little bit. We showed up here yesterday morning, we said the pledge and greeted everybody, and then we went on a day and a half of kind of doom and gloom, right? We're all wandering in the desert, thinking it's going to be 40 years before we find the promised land, and
It's only 35 for us.
yeah. Thanks. That's great. But yeah, so maybe it's not going to be as bad as we think, right? I mean, it's like we walk in here and everyone, you have to go and you're going to go home and hire 15 infrastructure funds and 10 direct lending funds and be perfectly happy, right? But maybe that's not the right answer. Maybe inflation isn't going to be terrible. Maybe you can get returns in the stock market. Maybe the yield curve moves pretty fast, right? And right now everyone say sell all your long duration fixed income and or at least reduce it dramatically, and that may be the right answer. That may be the right answer, but it wasn't that long ago that you could get a pretty good return on long duration fixed income, and it may not be that long in the future when you can get that. So I think the risks are that we're all lost in the desert, maybe.
So Derrick says chill out. Steve, what do you say?
Actually, I mean, he does really make an interesting point on fixed income, because I think going forward, there is the potential there. You've seen it in some of the corporate plans where, you could potentially start buying fixed income and actually start using that coupon income to, make your benefit payments going forward. I think we need to start looking at those opportunities. We're going to try building a liquidity pool that might cover 3 years of our benefit expenses going forward, at least the net benefit expenses, the part we have to come up with. I would like to see that pool expanded, and I think someday, maybe that could really be driven by just going out, buying bonds, and using the interest income from it to make those payments, and you can, de-risk, the plan that way.
So I appreciate your guys' comments so far. Before we turn it over just for a couple questions in our last couple minutes, really quickly, what excites you? As you look ahead for 22, 23, AKA so you can get about 100 GP calls from the people running those strategies. But really, what excites you in the rest of the year and next year?
All right, so
doom and gloom. Come on, Derrick.
So I mean,
home.
I think what's interesting is that we can a lot of programs have dramatically reduced their investments to energy, like traditional energy type companies, right? And this has happened. So there's a lower capital, and those traditional energy type companies are performing better. The banks aren't giving them capital to grow unless they are more financially sound. So to me, what's interesting is kind of an absence of capital from the energy space at a time when the financials of the average company is better today than it was 10 years ago.
Steve?
I mean, I definitely agree. I think you see a lot of this in terms of wanting, to move away from energy. And I mean, we're still consuming it in the same ways we were. I mean, there's going to have to be, massive changes in this country to move away from what we're currently doing, and it's going to take time, and it's going to make a lot of companies very investable going forward. I think Warren Buffett's on that train as well.
I don't mind investing behind him every once in a while.
No, he knows what he's doing.
I think some of the first-time funds excite me. I think a lot of teams that are spinning out right now, they're high quality. I think the focus on diversity and inclusion is kind of exciting now, and realize that really can drive your returns for you. So as fiduciary, you should really look at that.
It's great. Art, I apologize. We're going to go a couple minutes over just so we can, answer any questions from the audience. So I'll turn it out to you guys. I can't really see. Yes, sir.
How much is ESG a concern or part of your portfolio at all, or do you not care?
So the question was, how much ESG is a concern or a part of the portfolio today? Daniel, starting with you.
I'll be short. It's just another factor you look at. That's how I look at it.
Steve?
It's not a primary concern for us.
Derrick?
And we incorporate it into our process, but it's not our review process, but it's not a big push for our fund overall.
Yeah, and for our clients, we provide the information for them to make the judgment based off of their needs as an organization. Anyone else? Sir?
In terms of dealing with the complexity with alternatives and stuff as you're talking about, are you bringing in technology? Are there software tools or things that you're using, or is it more of a finding experts, whether that's with a CIO or someone as a consultant?
So the question was about transparency in private markets and leveraging data to assess that. So Daniel, maybe starting with you.
Sure. I think in the last 4 years, we've totally revamped our whole entire internal system of what we use. We have Clarity AI, which we use to determine on the ESG front different factors on different decisions we may make. So I think you have to leverage technology. But I think the big thing we do is really our consultant, leverage them and their teams.
And who's that?
Aksia.
This is my only plug. Come on. Derrick, how about you?
Yeah, I think that not really. The answer is not really. I mean, we're kind of we have firemen on our board, so we're mainly putting out fires. So.
Perfect. How about you, Steve?
Same thing. We would rely on our consultant. Do you want to know who they are?
Yes. Hey, I can handle it.
Makita.
Derrick.
We're with Aksia, but we run a parallel process. So we do our own work, they do their work, and we'll see if it comes out the same.
Any last questions? In the back over there.
Yeah, I guess, there is a concern about inflation and sort of the super cycle since, I guess, the 1970s has been a declining rate environment. We're now entering perhaps a new super cycle where certainly declining rates can't continue forever. And we're probably entering a longer period of rising rate environment. The only sector of the economy that empirically benefits from a rising rate environment is the financial services sector. And I'm not talking about fintech because I'll go out on a limb and say that's a bubble. I'm talking about like traditional old line financial services. Those benefit in a rising rate environment. And I guess, is that a sector that you're looking for exposure to, given those market conditions are manifesting? Or something you would, put on par with energy?
Yeah, no, the answer to that question I think is easier than you think. It's not really in the alternative asset world, right? The private equity is focused on fintech, like you said. Really, if that's your view, that like financials are going to do well, then that's a perfectly reasonable view in an inflationary environment. And but the real answer is European banks, because Europe is that index is loaded up with large banks. They perform very poorly for a long time in a low inflationary environment. If the script has truly flipped, European banks.
All right.
I just wanted to say thank you for that answer.
Thanks everyone for the time. Quick round of applause for our panel.